In our last video, we talked about personal cash flow. In this video, we're going to look how to increase your personal cash flow and get that increasing month over month, year over year. So just a refresher, personal cash flow is the money that you have left each month after taxes are taken out and all expenses are accounted for. So again, it's the money you have left after taxes and everything you spent for the month. So the idea is the cash flowing in or out of your bank account each month, or another way to think about, are you profiting or losing money each month? And remember, one note is because personal cash flow involves expenses, you will need to wait till the end of the month to make these personal cash flow calculations to get an accurate look at them. So when talking about increasing your personal cash flow, so the money you have left after taxes are taken out and expenses counted for, there's only two ways you can increase this. You either make more or you spend less. So you can actually make more money and have a worse personal cash flow if you spend more. So let's take a look at an example here. We got Sam and Allie, and we're going to look at the average monthly cash flow for a year between the two. And let's say Sam has an income of $95,000, a tax rate of 33%, and an average expense per month of $5,100. And then Allie has an income of $67,500. Tax rate is 28%. So your tax rate will be a little bit lower. If you make a little less, the more you make, the more the tax rate will increase. And then an average expense of $3,435 a month. So we're going to compare the personal cash flow monthly of these two people with these scenarios. So remember, get the income, divide it by 12. So Sam makes $7,917 per month. And the tax rate, we got to take that out. So 1 minus the tax rate of 0.33 gives us a multiplier of 0.67. And now we're going to do the same for Allie. Income per month is divided by 12, 5,625. Tax rate 1 minus 0.28 gives us a tax rate of 0.72. And so now let's figure out the personal cash flow for both because we have everything we need. So first we're going to take our income and multiply it by our multiplier. And that's going to mean after the taxes are taken out, we have $5,304 left for Sam. Now we just got to subtract those expenses. So Sam has an average monthly cash flow of positive $204. So he's saving $204 each month. Let's go for Allie now, do the same thing. Multiply it by our what we have left after taxes. And that's going to give us $4,050 per month after taxes. Now we subtract our expenses. And so that's going to give Allie $615 in positive cash flow for the month. And so let's compare those real quick. So even though Sam has a lot more income, Allie has a higher monthly cash flow. And due to a slightly higher tax rate and a much higher monthly spending, Sam had a lower average monthly cash flow despite making almost $30,000 a year more than Allie. So again, because he spent a lot more per month, he doesn't have as much saved at the end of the month. So again, just a reminder, think of your personal finances the same way a business thinks of theirs. And the goal of business is not to make revenue, but actually to make profits. So think of your income as your revenue and your cash flow as your profits. So we're going to look at some visual examples here. Again, no numbers, but just to give you an idea here. So let's say your income looks like this and your expenses looks like this. Again, this is a scenario where income is a lot more than expenses, so you're going to have very good personal cash flow in the scenario. What about this one where it's a little closer, income is a little bit more than expenses? This would be low personal cash flow, so your income is just a little bit higher than your expenses, but you're still profiting each month. And then again, we have something we really want to avoid consistently when your expenses are more than your income, and that's going to be your negative personal cash flow. Again, this will happen time to time in your life because you're going to have months when you overspend, but you want to avoid this consistently. So let's look at this for an entire year, an example here, and we're going to look at income and expenses for each month in this scenario, and we're just going to look at the good months, the bad months, and kind of the medium months. So let's say this is what a monthly cash flow looks like for someone in a given year. So if you see right here, February through May, this would be considered bad monthly cash flow because there's 2 months out of that where the expenses are more, so negative monthly cash flow, and the other two, it looks like just very, very low cash flow positive. So in those 4 months there, this person actually lost money because the negative cash flows outweighed the positive. But then looks like they got their act together here, and this would be considered good monthly cash flow because you see those gaps in income and expenses are staying consistently high. So if you look at this and you're to chart this, so that's a positive month, positive, negative, positive, 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 positive. So they're finishing out the year positive. And if you add all those up, and so that's all in the dark green is your positive cash flow, and then the red is your negative. And if you actually subtract those, which is going to be this blue line here, that's your total cash flow. And if you look at this person's cash flow over the year is actually more than a given month. And that is actually a good rule of thumb, is that you want to try to save more than your average paycheck each year. So if you, whatever your average paycheck is, if you can save more than that each year, you're doing a good job. So that was on a monthly basis. Let's see if we can track this on a yearly basis and kind of get a visual example of what would be a good looking cash flow scenario. So if you had 2020 through 2024, 5-year period, this would be a very ideal scenario for anybody where you see your expenses here have gone up just a little bit, so you're spending a little bit more, but your income keeps going up at a much higher pace. So those cash flows each year that you save keep getting bigger and bigger and bigger. And just think about it, that's very good because all of that is extra money that you have each year to put into investments that are going to compound over time. So again, the more you save each year, the more you have to invest and just put yourself in a better situation for the future. So that's all I have for you in this video, and just always a reminder to take it easy.